So good morning for everybody. Good morning, ladies and gentlemen. It is my pleasure to join you today at this already traditional conference. I think we were holding this conference for the third time. And also, first of all, I would like to thank all of you, speakers, panelists, and of course participants. I think we will have very good discussions today because the topic of today's is a very interesting topic, very hot topic. Having in mind my previous life, it is a very interesting topic for me too. I would like also to express my special thanks to our keynote speakers. First of all, my fellow colleague, Professor Klaas Knot, President of the Nederlandse Bank, and Henrik Braconier, Chief Economist at Sweden Finansinspektionen, who delivered the keynote speech yesterday. Also, at the beginning of today's, I would like to thank to employees of the Bank of Lithuania for very good organizational efforts, for organizational work, and of course my fellow colleague at the board, Thomas, whom financial stability, I think, is in his blood. Due to my participation at annual meetings at BIS in Basel, I was not able to be here when you began discussions about interlinkages between real estate taxation and macroprudential policy instruments, and shared country experiences in residual real estate taxation. But still, today's agenda promises us another intensive day with engaging discussions and hopefully some helpful answers. Dear colleagues, in welcoming you all today, I hardly need to list the benefits of macroprudential policy and its instruments. And I am sure that macro policy as policy works, especially as a preventive tool. Let's take current Lithuania as an example. The economy is growing, but we do not observe economic agents, creditors and borrowers acting irresponsibly. What we had prior to the financial crisis. I believe that other countries experience the SRB framework and the policy instruments prove, if not effectiveness, then at least potential of macroprudential policy. It is worth noting that we still lack clear evidence on the interaction of various macroprudential measures with other policy areas. This is true despite the fact that macroprudential policies have been gaining recognition and use among policy makers in many countries. In fact, data shows that the usage of macroprudential measures increased persistently in the immediate post-crisis years. This trend is evident in both advanced and emerging market economies, albeit to a different extent. In my opinion, measures directed at affecting crediting in the economy are effective tools with an impact on the economic cycle, and especially in current low-rate environment. We consider current timing to be appropriate to deepen our understanding of the links between macroprudential and other policies, as policymakers need to think in the frame of a well-balanced policy mix. I believe that policymakers' cooperation is a desirable outcome, but it may be hard to implement. Ideally, it would be beneficial but in reality it is quite difficult to achieve, primarily due to different goals and horizons as far as policy is concerned. Unlike before the crisis, today the mandate of the Bank of Lithuania includes both micro and macroprudential responsibilities. In practice, this means that with respect to decision making, we act as autonomous entity and do not require separate approval from other national institutions. And I think such a framework is very important for Lithuania. Yet, as tax policy is obviously beyond our mandate, we need broader discussions that often involve delicate political issues. Although most taxes affect individual behavior, property taxation is generally perceived as less distortionary than other types of direct and indirect taxation, especially labor taxes. Furthermore, property tax can produce a positive externality. It may contribute to ensuring financial stability. It is widely believed that demand shocks tend to amplify when property taxes are low, including excessive price volatility. This notion has some empirical support. For instance, many researchers argue that property taxes can reduce house price volatility. But here too, I believe that it's important to analyze the possible implications for economic cycles of different policies. One of the main areas where fiscal and macroprudential policies intersect is the housing market. In many countries, and in both advanced and emerging economies, governments intervene in the housing market. Such policy decisions can indeed contribute to financial stability, or instability for that matter. Additionally, there is some evidence that government housing-related intervention, for example, mortgage interest deduction and state-supported mortgage insurance schemes, can lead to larger house price volatility. This is especially the case when policymakers target policy goals other than financial stability, such, for example, as increasing home ownership rate. In the period leading to the financial crisis, here in Lithuania, we also had some fiscal incentives. First, before the crisis, from 2002 until 2008, there were income tax incentives for individuals taking housing loans. As a result, mortgage interest rates were effectively reduced by a third. Looking back, now we can say that those incentives were probably one of the factors which escalated irresponsible borrowers' behavior before the crisis, especially since it was not stopped early enough. Second, there was a housing loan insurance scheme which shifted the risk of the riskiest borrowers from banks to the state-owned mortgage insurance company. Naturally, this created grounds for moral hazard concerns. In other words, such government policy stands together with other economic factors, such as EU membership, plans to introduce euro in 2007, the enthusiasm regarding economic expansion, etc., clearly fostered credit and house price growth. Looking back, it is evident that policymakers failed to acknowledge the excessive boom in the economy. Subsequently, they did not make effective use of fiscal stabilization tools. By the way, looking back, I also can say that central bank also did not all what he could did at that time. The introduction of a universal property tax, or for at least a credible plan to do so, and the abolishment on time of the tax incentive could have had a suppressing impact on property prices. Indeed, according to ECD research, reduction of the tax deduction related to mortgage financing costs can reduce house price volatility. That would probably not have prevented the bubble from emerging, but it may have limited the damage. Returning to today, we see that Lithuania still does not have a universal residential real estate tax. Last year, the Bank of Lithuania released suggestions concerning the tax system. One of those suggestions was primarily related to the residential real estate tax, which suggested broadening the base of residential real estate taxation. Our proposals have not yet found their way forward politically. What we have today in Lithuania is a situation in which real estate taxation exists, but I would say more theoretically than in practice. And of course, first of all, I am talking about residual real estate tax. For example, last year, residential real estate taxation generated only 1.7 million euro as budgetary incomes, which is only tiny fraction, 0.02 of the total state budget income. OECD also reports that in total, real estate taxation in Lithuania constitutes around 0.4% of GDP. So real estate together with land tax, because we have different types of tax. Is that enough? To compare, total real estate taxation in Latvia constitutes around 1% of GDP. In Poland, more than 1%, around 1.2% of GDP. The OECD average, as is shown in this slide, is around 1%. So, due to the current tax design, real estate taxation in Lithuania has little real effect. This is clearly not a suitable outcome. The current discussion is relevant not only internationally, but also for Lithuania in particular, especially given our past experience. We, I mean many of us, still need to do our homework on the taxation design side. My understanding is that countries experience different problems and come up with different recipes for solving them, especially having in mind the fact that many of those receipts we regularly receive and repeatedly receive from, for example, Article 4 mission recommendations or country-specific recommendations from Commission. So today's policy discussion on whether real estate taxation and macroprudential policies are complements or substitutes is highly relevant. We will also continue looking into country-specific experiences, successful and less so, with residential real estate-related tax systems. In this respect, the experience of other countries can play a crucial role. Thus, I look forward to hearing from our keynote speaker about the policy receipts chosen and implemented in the Netherlands. To wrap up, this is the third macroprudential conference organized here in Vilnius, as was mentioned at the beginning. And I am glad to see that the agenda is filled with interesting presentations by people from many different institutions and with many different experiences. I am excited to open the floor to the discussions. I believe that we have a good mix of policymakers, researchers, and representatives of many international institutions. I wish us an interesting day and a fruitful exchange of views, hopefully leading to positive policy outcomes. And now, I gladly pass the microphone to our keynote speaker, Professor Klaas Knot, whom I know very good because he is my fellow colleague at the ECB's Governing Council. He also is a vice chair of the FSB. And please, guys, do not mix it with FBI because it's different bodies. And as you know, FSB is responsible for financial stability globally. Of course, having in mind the role of FSB, the question, who is more important institution? So, Klaas, floor is yours.
Thank you. So, thank you very much, Vitas, for inviting me here. and giving me the opportunity to exchange views on this very important topic of real estate taxation and macroprudential policies. By the same token, I must also say that I was a little bit surprised to see that it is actually me that you invited to come over to Lithuania to talk on this topic, because on my way over I sort of collected a few, let's say, headline data points on Lithuania and the Netherlands. And it seems that when it comes to this subject, on all accounts, you Lithuanians are actually doing a far better job than we do in the Netherlands, and for sure than we have been doing in the past. Where our loan-to-value limit still stands at 100%, yours is already being brought down to 85%, where I will talk the next 20 minutes about a rather generous mortgage interest deduction scheme that we still maintain in the Netherlands. Yours is already been abolished in 2009. So if the aim of inviting me over was to provide you Lithuanians with a bit of additional feel-good, then that is going to be my contribution for the next 20 minutes. But it may as well have been actually rather more appropriate had I invited you to come over to Amsterdam to talk a bit about macroprudential in Lithuania, and then I could perhaps send some messages to our politicians as well. Well, nonetheless, all sort of joking aside, let's at least use this conference to try to build together for a sort of collective set of lessons learned in this area. Because previous crises and downturns have demonstrated that residential real estate markets are a very important concern for both financial, but I will argue also macroeconomic stability. And this not only holds for my country, where we had a significant drop in house prices that started in 2009 and then also severely prolonged the economic downturn, but it's probably also true in a country like Lithuania, where you have home ownership rates of no less than 90%, if I understand well. In the past decade, the total value of residential real estate as a percentage of GDP has increased substantially in almost all developed countries. And often this surge in house prices was accompanied by a surge in household debt, which has made our economies even more prone to housing shocks. And you can see that in slide 1. And next to my joy with the country of Lithuania, I'm also always very happy that we have a country like Denmark in this region, which sort of prevents us from being in the complete left part of the slide. But how did this come about? Well, from, let's say, the Second World War onward, housing policies in many countries became much geared toward promoting home ownership. And this worked through favorable tax treatment of housing and the deepening of mortgage markets. And home ownership rates have in almost all countries been steadily on the rise. And the Dutch case here is by no means an exception. In this keynote, I would like to share the sort of long experience that my country has had with tax relief on mortgage interest, or as I will refer to it today, mortgage interest deduction, or in short, MID. But I will also try to discuss a little bit our experience with the new macroprudential tools that were introduced after the global financial crisis. I believe that the Dutch case is an interesting example of the distortive power that mortgage interest deduction can have. And it also clearly illustrates why macroprudential policy is especially needed in such an environment. First, I would like to look back over a century of mortgage interest deduction in the Netherlands, what it was up until the global financial crisis. Secondly, I will then take some time to discuss the measures that were introduced in the wake of this crisis. And thirdly, I will discuss in a somewhat broader context how I believe that macroprudential policy and real estate taxation should ideally work together in stabilizing housing markets. And it is in this third part especially that I hope we can combine all the insights, the thoughts and the experiences that we've all gained. So in the Netherlands, mortgage interest deduction was introduced already in 1893 by the then finance minister Nicolaas Pierson, who later also became central bank governor and who is a famous economist in the country that I come from. He then sort of overhauled the tax system, and he shifted the tax base from what was mostly indirect taxation towards taxation on sources of income. Now, in this new system, a house was seen both as a source of income, so rents or imputed rents were therefore taxed, but the costs, like, for instance, interest payments, could be deducted. So there was a consistency in the system. Already back then, on a net basis, most homeowners and landlords with a mortgage loan received a subsidy, since the rental income was taxed relatively lightly. And I think this is also what I heard you say, Vitas, which is still true today in many countries and also here in Lithuania. However, the effects of mortgage interest deduction in the early decades were still relatively contained, and that was because home ownership rates were very low, namely less than 20% in the 1920s. Moreover, getting a mortgage loan was nearly impossible for most households, since a substantial down payment at that time was still required. You can see in the slide that only after World War II, in many countries and including in the Netherlands, the idea slowly emerged that more home ownership would contribute to welfare and should therefore be further promoted. In general, the housing shortage at that time meant that the governments were willing to take drastic action to stimulate access to housing. The introduction of a mortgage guarantee scheme in 1956 meant that more and more households could access the mortgage market. Since the government guaranteed the loan, that it would be paid off, lenders were willing to take on additional risk. And they were also able to loosen their down payment constraints. Additionally, households that wanted to buy a newly constructed home were eligible for additional subsidies that were introduced to stimulate building. In Dutch, we call them the premiewoningen, the so-called premium dwellings, I think one would say in English. Meanwhile, you can see that home ownership, but also mortgage debt, were steadily on the rise. By the 1970s, 35% of all households were owner-occupied. By the early 1990s, this number stood at 45%. And currently, home ownership in the Netherlands is almost 70%. So still a bit lower than in Lithuania, but significant. From the 1990s onward, the Netherlands experienced a spectacular surge in mortgage debt and house prices. From 1995 to 2008, house prices more than doubled in real terms. In fact, it was 110% increase in real terms. That is correcting for inflation. And mortgage debt also increased in the same time, from around 50% of GDP to over 100% of GDP, as you can see in this next slide. It is also in this period that households and mortgage suppliers, i.e. predominantly the banks, discovered very, what I would call, innovative ways to fully exploit the tax advantages of mortgage interest deduction. New mortgage products were introduced that combine interest-only mortgages and hence maximum tax deduction with saving or investment accounts that allow for deferred amortization. So people didn't amortize their mortgage anymore during the course of the mortgage. It was interest only. At the same time, a saving account was built up, and the moment mortgage interest deduction came to a halt, there was a one-off amortization of the whole mortgage loan. At that time, mortgage suppliers also gradually started to loosen their credit standards. First, by allowing households to increase borrowing, by including, for instance, partner income for determining the maximum mortgage. Until the mid-1990s, the maximum mortgage was extended only on one income, on the main income. That, of course, was no longer sort of maintainable given, let's say, societal developments, given the much higher labor force participation of women in the Netherlands. And then the banks really jumped on it and started to use both incomes as a base to determine the maximum mortgage. On top of that, borrowing at loan-to-value ratios of 110% or even higher also were not an exception anymore in the early 2000s. And on top of that, households also started to withdraw home equity after sort of periods of prolonged price rises by taking out an additional mortgage on the same piece of property. Now, although I would be the first to admit that these practices in hindsight seem outrageous, we must remember this. In part, the high levels of borrowing by Dutch households are the flip side of equally high mandatory savings through the pension system in the Netherlands, where contribution rates of around 20% of gross income are not exceptional. So in the Netherlands, if you work 5 days a week, 1 day a week, you work for your pension. And your current income is only the income of the remaining 4 days a week. So liquid savings of Dutch households, for instance, to use a down payment for your first mortgage, are therefore quite limited. And with home ownership being subsidized to this extent, the only viable option for many households to fulfill their housing needs was therefore to take out very high mortgage loans. As I mentioned before, the global financial crisis, followed by the euro crisis, hit the Dutch economy quite hard. One can imagine that the high loan-to-value ratios of Dutch households and a fall in house prices resulted in many households then facing negative home equity. At its peak, no less than 35% of Dutch homeowners were underwater, so with a mortgage value that exceeded the sort of the value of the underlying property. It will come as a surprise to most of you, but foreclosures and arrears remained at very, very low levels during this entire period. Somehow, Dutch households always keep meeting their mortgage payments. Now, some believe that this is deeply rooted into our Calvinist culture, but I believe that also our strict personal bankruptcy procedures play a large role in this as well. The position of mortgage creditors in the Netherlands is very strong. Banks and other creditors may even evict residents from their houses without judicial interference. But while households kept making their monthly mortgage payments, of course, they had to drastically then cut back consumption. A recent study at the Netherlands Bank showed that internationally, and this is a scatterplot of several countries, the response of consumption to changes in house prices is positively related to the share of households with a mortgage loan. The dot in the top right corner here in this slide, that is the Netherlands. So while the direct losses for financial institutions were relatively low, the macroeconomic consequences of having such a highly indebted household sector were severe. The recession following the financial crisis made it clear to policymakers and politicians that mortgage debt had risen far beyond optimal levels in the Netherlands and led to excessive macroeconomic volatility. Finally, the time seemed right for a discussion on the effects of mortgage interest deduction. And the Dutch Central Bank, together with other economic advisors, had already recommended scaling back mortgage interest deduction for many, many years, but finally it found a willing ear. The M word, as we call it, mortgage interest deduction, up until then had been a political taboo. But now, also in light of the fiscal deficit at that time, cutting foregone tax on earnings due to mortgage interest deduction was finally on the agenda. In 2011, the total tax advantage due to mortgage interest deduction amounted to no less than 14 billion euros, which amounted to roughly 2.5% of our GDP, the foregone tax revenue due to this deduction. Eventually, the cabinet took various measures to reform the housing markets. This was early 2013, and I would like to highlight 3 of them. Firstly, for new mortgages, it was decided that they would only qualify for mortgage interest deduction when the loan was fully amortized in 30 years. Figure 5 shows the result of that policy measure becoming effective in 2013. While annuity mortgages, and annuity mortgages are the sort of yellow-green part of this slide, were almost non-existent in 2012, up until 2012. In 2013, unsurprisingly, the new flow contained a large volume of them. And the fact that there are still interest-only mortgages and saving mortgages in the flow, even after 2013, that is mainly due because of existing mortgages being rolled over, because there was a grandfathering clause for all the mortgages that already existed before 2013. Secondly, and finally, I would say, also an LTV cap was introduced in 2012 at the level first of 106%. And from 2012, it was then decided to reduce that cap by 1 percentage point per year for 6 consecutive years until it reached 100%, which is where it is today. Now, most international guests of you will probably raise their eyebrows. 100%, can you even call that a cap? But for many Dutch households, this was actually fairly binding, I can assure you. And if you want to maximize political opposition to a measure, then this is one where I think it would be very well qualified, because households have simply gotten used to being able to finance all kinds of transaction taxes, broker fees, solicitor fees, using their mortgage loan. It was all included in the mortgage. Boats, second houses, etc. I won't talk about. So thirdly, also debt service to income limits that appeared to have been not consistently applied before the financial crisis were now also written in law. And they now also apply to all mortgage suppliers, so the banks and the non-banks alike, because also insurance companies and pension funds do take a certain part of the mortgage market in the Netherlands. And increasingly so, by the way, in this low interest rate environment when everybody wants to take out an even longer maturity mortgage, which makes them even more suited for insurers and pension funds and perhaps a little bit less suited for bank balance sheets. But that's an aside. Although I do welcome the steps that have been taken in 2013 and also more recent steps to seriously start scaling back the maximum rate at which mortgage interest can be deducted in the tax system, the situation in the Netherlands is still far from ideal. Mortgage interest deduction is still among the most generous in the world. And although the Netherlands is one of the few countries where both DSTI and LTV limits apply, both of them are still very high by international standards. As president of the Netherlands Bank, I will therefore keep stressing that additional reforms are needed. So now on the interaction between macroprudential policies and taxation, we concluded that taxation in most countries favors an owner-occupied housing system. And in some cases, it's even very explicitly so via mortgage interest relief, as you can see in figure 6. In other cases, because housing wealth is taxed much less than other sources of wealth, and I think that is also an issue here in Lithuania. Tax systems therefore generally contribute to cyclicality instead of containing it. And macroprudential policies are therefore often partly in place to offset the negative elements of the tax system. And this is the most clear when the tax system induces a debt bias, as it does in various countries that still offer mortgage interest deduction. However, in fact, it also holds when the tax system favors investment in housing over other sources of wealth. In most countries, the idea that home ownership is the preferred tenure for all households is still deeply embedded in society. But from an economic viewpoint, the case for home ownership over renting is much less clear. The often mentioned pros, like better maintenance of properties, and cons, like less labor mobility and more indebtedness in society, are at best in balance, I would say. So from a fiscal perspective, I therefore believe that countries should strive to move to a tax system that is more or less neutral with respect to home ownership versus rental system. Not only would this benefit financial and macroeconomic stability via structurally lower debt and real estate prices, it would also create more of a level playing field for private rental housing. Currently, the supply of housing in this segment of the market is often suboptimal. In my country, this segment is still dominated the housing market in the post-war years, but now it only makes up a small fraction of the total housing stock. So yes, I believe that proper real estate taxation and macroprudential policies are to some extent substitutes. But fiscal incentives are not the only source that can amplify residential real estate cycles. The feedback loop of adaptive expectations of house price appreciation remains another source of risk. Exuberance leads to more exuberance, panic leads to more panic, also when taxation does a better job than it is today. So macroprudential tools, such as debt service to income and loan to value limits, can structurally limit this mechanism and at the same time protect households from over-indebtedness. I realized that I formulated the sort of typical nuanced answer that you expect here from an economist. Real estate taxation and macroprudential policies are both substitutes and complements. I hope for everybody here in the room that the panelists in the next session, where this question will undoubtedly also surface, will be a bit less nuanced so that we can have a lively debate here. But before we move over to this next session, let me say a few more words in conclusion. As I stated at the start of this keynote, the impact of volatile housing markets on financial and macroeconomic stability is really significant. To me, the Dutch case clearly illustrates that too much household debt severely exacerbates this mechanism. In my view, current tax systems often contribute to cyclicality by either incentivizing debt financing or stimulating investments in housing over other investments. In such an environment, macroprudential instruments are partly in place to offset these features of the tax system. Ideally, however, I would like to see tax systems and macroprudential instruments working in tandem to structurally limit the risks of accessing house price growth and leverage. Therefore, I believe that for us as policymakers, there are still very important steps to be taken in the coming years. In various countries, there is still a lot of room for improvement to extend the macroprudential toolbox or by fine-tuning the existing instruments. Moreover, in most countries, the tax system can be improved to reduce cyclicality. Residential real estate taxation should therefore gradually transition to a level much more comparable to that with other sources of wealth. I want to emphasize here that when it comes to macroprudential tools and real estate taxation, I do believe in a structural approach. Using these tools to sort of lean against the wind by making discretionary changes to them through the cycle is, I think, far more difficult and is also a bit of a risky exercise for us policymakers. That all said, I would like to thank everybody here for coming, listening to me and giving me the stage. And I really hope that this conference will push this essential issue higher up the international agenda. Thank you very, very much.
I would like to thank the governor of the Bank of Lithuania, Vitas Vasiliauskas, for an excellent welcome remarks, and even a bigger thank you to the president of the Nederlandse Bank, Mr. Klaas Knot, for a thought-provoking keynote speech and sharing the Dutch experience. And without further ado, I would like to start the third session on real estate-related taxation and macroprudential policy, substitutes or complements. And I would like to invite the moderator of this session, Ms. Denise Egan, who is the Deputy Chief of Macrofinancial Division of the Research Department at the IMF, to present the speakers of this panel. Please, Denise.
Well, thank you, Christina. I'm not going to take too much. Some of the speakers you already know, and I think we're going to segue very nicely into this session. asking directly substitutes or complements. And we're going to have Thomas, who needs very little introduction, member of the board at the Central Bank of Lithuania and our gracious host. And then we're going to hear from Marja Nikkunen from Bank of Finland, looking at from the Finnish side and sharing experiences from there. And last but not least, we're going to hear from John Fell from ECB and bringing it all together, going back to the main question of substitutes or complements. And I look forward to a very lively discussion.
Okay, very good sound. So good morning, and once again, thank you to Vitas and Klaas for excellent introduction. It's a first panel today. At the same time, it's a second policy panel in this conference. And here I'm actually replacing our Minister of Finance, who unfortunately could not make to the conference. But I'm going to talk about macroprudential view of the world. So the fiscal perspective, I'll try to cover it a bit as well. But of course, given that I represent macroprudential authority, macroprudential view is likely to dominate nevertheless. Let me start by addressing the key question at the beginning, the first slide, why taxation is important for financial stability, why we're looking at this issue. And to simplify the question, to simplify the answer, I would suggest to look at two channels, asset price channel and the debt channel. And let me start with the first channel, which basically views housing as an investment good, because I think the risk for financial stability would come from that role of housing. And and here we have, of course, we are concerned about house price volatility. Volatility is a code word used by academics for basically a boom and bust cycle and asset price bubbles. And the way these two policies are linked here, I think it's mainly how taxation works. It's through the incentives. And taxation could have huge incentives. You can basically tax anything. You just create if something, then I tax. And taxation is a very powerful tool. And in this particular area is what incentives are important. It's important when there is a preferential treatment of residential investments as compared to other potentially more productive assets, such as equities, bonds. And the second point, which actually was mentioned as well in the keynote speech, that taxation is not always neutral with respect to whether to the choice whether to own a house or to rent it. So here, if it's not neutral, taxation is not neutral, distortions are possible, which eventually might lead to house price volatility. And the second channel is debt, the obvious channel. This is actually the main channel for the macroprudential policy. The main concern is the credit market. And in this case, we are concerned about high household indebtedness as a source of risk and vulnerability for the economy. And here, of course, the obvious sort of wrong examples of bad incentives when taxation encourages debt finance purchase of housing. Even if person could choose to buy using cash, using savings, or to borrow, sometimes the fiscal incentives are there, and basically they encourage debt finance purchase of housing. At the same time, even if in some cases there is a general debt bias in taxation, also for corporates, but when there are incentives, strong incentives to buy or invest something with the debt financing, mortgage debt even might be treated preferentially, as we saw yesterday in the case of Norway. So really, mortgage debt is treated even in a more preferential way than other kinds of debt. To sum it up, it's very simple. The message is very simple. Probably it's not going to surprise you. It all can be summed up in a very simple way. So the key risk here is a promotion of debt-financed home ownership. And this is basically the key conclusion. And this framework is going to have an impact on the rest of my presentation and basically summarizes the structure, how I view this interaction of two policies. Let me start by giving you sort of a life cycle, if you want, a taxation life cycle of a particular property. And we have many taxes which are linked to housing. And of course, it starts all with the purchase of an apartment, flat, or other type of housing. And I probably don't need to go through. Yesterday, we covered a lot of them, so I'm not going to repeat here. Probably the structure is that all the taxes are at sort of at below the line. Only mortgage interest deductibility is above the line. And I also include inheritance and gift tax, which is a natural part, sort of. It's also linked to these other things, which I think yesterday wasn't covered that much. Apart from I think Denise had this in her presentation as well. So let me start to go one by one, going a bit deeper into each tax. And of course, the obvious starting point is the stamp duty, which was covered extensively yesterday as well. And there is an obvious link with macroprudential policy via a down payment requirement. And these two are linked because usually the stamp duty is paid by the buyer, which means from the buyer perspective that the person, in order to be able to buy an apartment, has to save even more than just a down payment. The person also needs to save for the stamp duty and also transaction costs, which in some cases can be quite substantial. We'll have more information about that later on. Stamp duty is quite controversial and very much disliked among the public. And its main benefit is that it may restrain speculative activity or even could be used to manage a bit foreign purchases by foreign investors, as it is the case in Canada and New Zealand. In European Union, that probably would not be possible. We cannot discriminate buyers by sort of their residency. Although I'm not a tax expert, I don't know if it would be possible in European Union country to sort of have different stamp duty tax for purchases from third countries, but this is a question for tax experts. I'm not going into that. And the sort of the drawbacks of stamp duty are obvious because it may reduce market liquidity, create welfare laws, may also limit labor mobility and sort of home exchange. From macroprudential view of the world, and going back to the incentives which I mentioned in the previous slides, so this stamp duty tax has no negative implications. So it's actually quite the mere existence of the stamp duty. It discourages actually purchase of housing. So the people, it sort of encourages people to prefer other assets for investment purposes rather than housing assets. And it also encourages people to rent rather than to buy. So from financial stability point of view, stamp duty there are no obvious sort of risk sources from its use. And it's quite neutral, I would say, with respect to whether sort of preference is now given, whether debt finance purchase or using cash savings. In Lithuania, we have no stamp duty, but we have a notary fee, which is, I wouldn't say it's very high, 0.45%. It's capped as well in absolute amount and usually split equally between the buyer and the seller. And LTV requirement in our case is 85%. I won't go into other details, just give you a summary of those requirements in other countries. Before the conference, we ran a quick survey among the membership of ECB and ESRB subgroups. So we have 23, it was a voluntary survey, 23 answers. It's not a hard statistical data, so I wouldn't rely too much on numbers because there are many caveats. We would need probably a second round, but that gives you an indication on the size of these savings, which from an individual's point of view, before you enter the housing market, what are the costs? And of course, this gives you only a partial picture if we were to add also LTV requirement. So it's kind of quite a burden if you want to buy an apartment. You need to save, in some cases, quite substantial amount. As I said, this is not the perfect data. For example, in the case of Germany, there was no data in the survey on the typical LTV requirement, so it's still not the perfect sign, but at least it gives you indication that in some cases, overall requirements can be, and sort of savings which are needed to buy an apartment are quite substantial. So the second tax, recurrent property tax, usually paid on an annual basis. And there are many ways actually how to structure this particular tax, and design is very important here. Could be flat or progressive tax rates, and from the financial stability point, I think, which often is important, whether secondary or subsequent housing units are taxed differently, because typically this is where the main risks lie when people start buying more apartments for speculative reasons or for buy-to-let reasons. That's where we see, from financial stability point of view, more risks. If it's a primary residence, that's of course it's a more consumption for consumption purposes. And with respect to incentives, again, the property tax is a good measure. It's not distortive, and it's not per se, it doesn't create financial stability risks, because still the mere existence of a tax encourages people to invest rather in other assets for investment purposes rather than residential real estate. It also forces you to consider renting option as well, and it's rather neutral with respect whether to use a debt finance or just to buy using your savings. And the more punitive a design, sort of the more these disincentives to invest in housing, these disincentives are stronger. And I mentioned already, the higher the tax rate, property, and the more punitive it is, the stronger are these incentives actually to go into overinvestment into housing assets. And there was a bit of a coverage in the case of Norway, where they still have, one of a few countries which still have wealth tax. So deduction of that is also an important element, which was, I think, wasn't mentioned yesterday. But in some cases, it is possible, even without the wealth tax, there could be only sort of preferential treatment of mortgage debt, because if you have a property tax, your deduction of mortgage debt, it could be allowed actually to deduct mortgage debt, and in that case, that would be a huge favor for leverage investing, and that could be a big issue. So I think, in addition to mortgage interest deductibility, this kind of deductions would be very risky from financial stability point of view, because in Lithuania we had a few proposals. Maybe that should be considered and deducted from your tax base. And some information about the effective annual property tax, again, is from our survey. So the survey indicated or provided a standard sort of apartment. So there are lots of caveats, and we haven't had all the responses, but it gives you at least some indication. But I think we'll need a second round to improve a bit and to get more, to get some clarifications and improve the data here. But nevertheless, it's interesting to observe that actually the highest effective tax rate for a family with 2 children was 0.4 in our survey. Inheritance tax, why it is here? Because it's linked to the current property tax. Inheritance tax could be viewed as a postponed recurrent property tax, but the latter, because if you do it every year, it's probably easier to stomach over time, but they are linked, very much linked. And at the same time, the tax can be sometimes quite substantial. It creates various incentives to minimize it, and it should be viewed together with the gift tax, which at the same time has to be sort of viewed aligned with the capital gains tax. So with all the taxation framework, it can be pretty complex, and you need all of them together in combination, because there might be loopholes if you sort of misalign those taxes. And then, of course, people are very creative with tax evasion. Lithuania. So in Lithuania we have value-based progressive residential real estate taxation, and it applies to the combined value of all properties owned by an individual. But it starts from there is a threshold from 220,000 euros. And the governor actually already indicated that the amounts collected are quite tiny. We'll go into that. But let me first give a few details. We had a change in 2018. So initially there was a flat rate of 0.45% above the threshold of 220,000 euros. And the proposal was actually to introduce a progressive systems with increasing rates up to 2%. I think 2% is a bit draconian from my point of view. Naturally, we expected quite some impact on the housing market. And as an economist, we immediately started trying to assess this impact, obviously. So theoretically, first, of course, the difference is very clear with the new proposal. For example, if we were to look at different taxable values, for apartment or combination of apartments with 2 million, the difference is quite substantial. So just compare 9,000 euros and 32,000 euros is basically a price of a new car. So yeah, one could expect quite a substantial impact, especially for high-value properties. And one way to assess that potential impact, of course, what we economists do, we discount the difference. There is a difference in cash flows. You just discount that difference in perpetuity, and then some assessment is possible. And in this case, the gray bars actually represent original value, and then depending on the discount, what could be values after implementation of a tax reform. So in some cases, the drop in price is quite substantial. So we're expecting quite an impact, but maybe just one more thing before I move. It just also illustrates the power of low interest rates. The lower the discount rate in the low interest environment, so taxation can have very, very powerful impact on prices. At least this is what theory is suggesting, but nothing happened. And this resonates with a message which was given by Henrik Braconier yesterday, because in Sweden also they expected quite a substantial impact, but not much happened. And why is that? It's because of distribution of house values in Lithuania. The threshold is too high and very high in the case of Lithuania, and not so many properties are there with high market values. So of course, given the threshold, one shouldn't expect much impact. And another reason is that taxable values are derived by using mass valuation methods, are often much below market values. The method itself is good, and actually the World Bank assessment is that we're using quite a good system overall. But these mass valuation methods often miss many things, and the taxable values are often below. So we have sometimes strange cases when nice apartments, maybe a few 1-2 million. Sometimes the taxable value is like 300,000-400,000. So the issue, even in theory, the tax system could look nice on paper, but the implementation part is very important. Because of these particular valuation issues, I think which was mentioned also yesterday by our OECD speaker and by other speakers, is implementation is also critical. And for other countries, in Denmark, we had discussion about the taxable value versus market value issues. It can basically have a huge impact, even though the design is okay, but the impact might be very, very different. Personal income tax, and let me start by rental income, nothing new here. And I think the comparison here, so that there is no preferential treatment of investments into residential real estate. The key thing is we could view rental income as dividends if people were to choose to invest in equities, for example. So this comparison is relevant. It's not always straightforward, but at least it should be taken into account on relative taxation between these two types of investments. Capital gains tax, widely covered yesterday. I won't go into the details here. There are many exemptions, and these exemptions might cause some trouble. But it's, of course, obvious disincentive, but whether it's powerful, it's a big question mark. And I think empirical evidence says that if there is, looming profit in the horizon, the tax rate is not that important. People still would probably likely to prefer to take to buy and sell it later at a higher price. In Lithuania, also not much different from nothing special, I would say. Rental income and capital gains are taxed at 15%. But we have a special case. We have a possibility to provide rental services with a time-limited business certificate that can be acquired for fixed fees set by a municipality, which basically distorts the system, and it provides sort of the people who are active in this rental market. So sometimes they pay very low taxes. So from that point of view, it's this possibility to have business certificate. It's a bit also weakens the tax. And the final part, the obvious part, I won't go into the details. Deductibility is quite a big issue, I think, from financial stability point of view. We've had many examples and even empirical evidence. This is quite an issue. And from our survey, 9 out of 23 countries, they still have this mortgage interest deductibility. Sometimes it's capped. I think in Estonia it's capped. But nevertheless, what is interesting from this list of countries, you see lots of countries from this region, from Nordic countries, Estonia, and actually markets in residential markets in Nordic countries are quite buoyant. It's you need more, of course, evidence, more research to prove that, but I think this is also linked as well. So we abolished deductibility. Sorry. Oh, I was a bit, no, sorry. Too far. Yes, so we abolished deductibility immediately in the aftermath of a crisis. But still, because for some loans they still were granted long time ago, it's still being applied. But for sort of the stock, the part of the stock which is still can benefit from that deductibility is increasing over time. It's just getting smaller and smaller. Given the main question of a panel, I have a few slides on this question. Thanks to John, he reminded me, because I jumped into this panel a bit unexpectedly, and John reminded me to cover this question as well. I know John is going to talk a lot about this in a very comprehensive way, as always, but I will simplify a bit. I prefer to do it in a more simple way. So I'll go by tax, and let's start with the stamp duty. I think it's obvious it complements. It does not substitute, but it complements a loan-to-value requirement. And because it affects the fact of the timing of credit and property demand, if you need to save, in addition to the down payment, you need to save stamp duty, of course it forces you maybe to postpone your buying decision. And by changing the stamp duty, you can affect actually that demand to shift a bit, to move to the present or maybe shift to the future. And I view it more from a demand management perspective. Recurrent property tax. It actually has a dual role. It's both complement and substitute, because in some cases there could be some developments which are not linked to debt. There could be bubbles, of course they're quite theoretical, which are not financed with debt. And in that case, macroprudential policy has no tools how to intervene in such a case, whereas taxes, they can do basically everything. With taxes, you can you can sort out many issues, and this is one particular example where recurrent property tax is macroprudential policy. But at the same time, for example, by taxing stronger taxation of secondary and subsequent housing, you could complement macroprudential, actually substitute if there are no, for example, strict requirements for secondary housing. Taxation could actually take care of this particular issue, and maybe even in a stronger way, but that's of course an empirical question. And finally, the point which I've made already, this deductibility of mortgage debt. So when you calculating the tax base, if it is allowed to deduct your mortgage debt, that's also very bad from financial stability point of view, because it provides incentives actually to leverage your purchase of a housing. Next point, personal income tax. I think nothing new here. That you need to have capital gains taxation and rental income taxation, but it's clearly it's not sufficient in this case to substitute macroprudential policy. And this deductibility is issue. I think it's very clear. Could be the message of the whole thing. Could be very clear that this thing needs to be abolished. And I think European Systemic Risk Board. It's a bit of a tricky question. Maybe it could go somehow in that direction and make stronger recommendation in this regard. And a final remark from my side is that we could view this question whether two policies are substitutes or complements by looking how they help to achieve two main macroprudential objectives, namely resilience of the financial system and moderation of financial and credit cycle. So here, I would say that taxation is not able to help us with better resilience. Macroprudential policy is better suited to help in this regard, whereas for the second objective, to moderate financial sector, to moderate financial cycle, I think both policies are quite potent in this regard. To conclude, my conclusion is very simple. You saw it before. This is a conclusion. Don't promote debt financed home ownership or sort of don't promote leveraged investments in housing and possibly also in other assets. Thank you.
So good morning and greetings from Helsinki, which seems to be as sunny as Vilnius today and yesterday. It's nice to have an international conference up here in Nordics or Baltics in these times when the weather is nice and also the people outside the conference are smiling. I wish to thank Lietuvos Bankas for the kind invitation to share our views, the Bank of Finland's views on macroprudential policies, financial stability, and also real estate-related taxation. My presentation will cover three perspectives. I will start by going through some recent trends in the Finnish housing market and household indebtedness, and their relevance for the financial stability. Many of these trends, like the urbanization, are likely to be common to other countries as well. Second, I will describe macroprudential policy objectives in Finland and instruments addressing vulnerabilities in the residential real estate markets. Finally, I will discuss the role of residential real estate-related taxes, mainly from the macroprudential point of view. To start with, I will go through the mandates shortly. The macroprudential authority, the decision maker in Finland, is the board of the FinFSA, the Financial Supervisory Authority. Bank of Finland, the central bank, has also a financial stability mandate, which is regarded today as the second key pillar of central banking. The parliament and the government decide and implement taxation and fiscal policy, including residential real estate taxes. Despite these different mandates, it is important to discuss and analyze the joint effects of both macroprudential policy and real estate taxation, as we do here in this conference. Some facts about the Finnish housing market. Widening regional divergence has been a major trend in Finland housing and credit markets in the past decade. Housing market divergence is largely consequence to an urbanization, a global megatrend, which often goes hand in hand with financial growth and economic growth. Growth in house prices on average has remained modest in Finland. At the same time, however, house prices in urban centers have significantly diverged from the rest of the country. Insufficient supply of housing in the growth centers would increase the risk of local price bubbles. Regional divergence in house prices is also reflected in the amount of debt held by households. It means that more expensive houses, more expensive housing and apartments, that means more debt. Vulnerabilities related to residential real estate lending and markets are one of the key sources of systemic risk, but increasingly in Finland with a regional flavor. The differences in local housing market conditions may be increasingly important in determining how dangerous household indebtedness is for financial stability. House prices in Finland, as you see in this picture, are not showing signs of worrying rapid rise or widespread overvaluation. However, price and demand differences on the Finnish housing market are large, and urbanization has only further increased them. In this picture, you see that real house prices have risen from 2010, mainly in Helsinki and some other major cities, whereas the rest of Finland, the prices have mainly fallen. The concentration of population in growth centers is also reflected in household indebtedness in Finland. Housing loans are large and have grown especially in regions where housing is more expensive and subject to greater pressure from demand. Large housing loans are most frequent in Helsinki metropolitan area and its surrounding municipalities, and in other growth centers, which are typically university cities and their surrounding municipalities. The lack of affordable housing in growth centers is widely considered to be one of the bottlenecks for employment and economic growth. High house prices, among other things, may restrict migration and reduce housing mobility within the labor market. This picture illustrates the labor market mismatch between vacancies and skills of job seekers, which have worsened particularly in Helsinki area and some other growth centers. You see the comparison between 2006 and 2016. Here, which is later, this one, you see the trend showing that the number of vacancies to fill and also the unemployment rate have increased in Helsinki and these other growth centers. Meanwhile, the development in other areas of Finland has been very stable from 2006 to 2016. It's widely acknowledged that high household indebtedness can be detrimental to financial stability and real economy. Financial and economic crises have often been preceded by excessive debt accumulation by households. In countries, here are some Nordic countries mentioned, with high level of average housing debt prior to global financial crisis, consumption growth was weaker than elsewhere following the financial crisis. In the downturn, households began to cut their spending in order to service their debts and to save for even rainier day. Private consumption contracted or grew at a lower pace, particularly in countries with higher household debt to income ratio. That is, the more households accumulate debt during an economic upturn, the more they are prone to cut consumption in a downturn. Now I will move to the objectives of the macroprudential policy in Finland. The main objective is to reduce the probability and adverse effects of the real economy on the real economy of financial crisis and other severe disruptions to financial system, and thereby promote long-term economic growth. The competent authorities pursue this objective by mitigating macroprudential risks and vulnerabilities by means of macroprudential instruments and communication. The measures are aimed at preventing systemic risks associated with household debt and structural vulnerabilities in the financial system, and improving the risk resilience of the financial system. The key residential real estate vulnerabilities in the Finnish financial system include historically high household indebtedness relative to income, high growth of indirect real estate lending to household through housing company loans. These housing company loans are a Finnish speciality where we actually can see the consequences of reduced tax deductibility of mortgage interests. Easing of lending standards of new housing loans, meaning margins, initial maturities, and interest-only periods, and widening regional divergence in the housing market as described earlier. Furthermore, the Finnish credit institution sector is large, highly concentrated, and also interconnected with the Nordic financial system. In accordance with its macroprudential strategy, the board of the FinFSA, the supervisory authority, has taken several complementary macroprudential measures. These measures can be divided into borrower-based measures addressing lending standards and capital-based measures which aim at strengthening banks' resilience. These instruments can also be seen as demand and supply side measures. In Finland, borrower-based measures include the maximum loan-to-collateral ratio on new housing loans and several non-binding recommendations issued by the board of the FinFSA. These measures have direct impact on borrowing and thereby on demand for housing of constrained households. These measures may also shape house price expectations and therefore influence the demand for housing also of households that are not directly affected by the measures. The capital-based measures taken in Finland include the systemic risk buffer, OSI buffer requirements, and minimum risk weights floor of 15% for residential mortgage loans. And just to mention that the latest decision on these macroprudential tools was taken by the board of the FinFSA last Friday on the 28th of June. The local housing market conditions ultimately determine whether the market adjusts to demand shocks through prices or supply. Macroprudential policy is, however, usually applied consistently across all regions within a country and therefore most likely relatively inefficient in addressing the differences in different parts of the country and local housing market conditions. Macroprudential measures can also have more indirect effects in the housing market. For example, if a financially constrained household buyers withdraw from the housing market due to borrower-based limits, sellers of certain type houses may face different difficulties in finding trading partner. In the presence of matching frictions, borrower-based limits may reduce housing market liquidity and therefore lead to larger idiosyncratic price dispersion and longer time on the market. 2 years ago, the main topic of this conference was whether macroprudential policy should target real estate prices. The widely accepted view was that not explicitly. Nevertheless, house prices are an important indicator and they are used to warn growing vulnerability and systemic risk in the financial system. In the macroprudential analysis of risk and vulnerabilities, the residential real estate markets, taxation is often seen as a structural factor which can have either mitigating or amplifying effect on the housing market dynamics. Governments in many countries have a long tradition of conducting tax policies which encourage households to borrow in order to acquire owner-occupied housing, in particular in case of first home. And I think that we here, just before my presentation, heard 2 examples, one coming from the Netherlands and one coming from Lithuania. These tax advantages and incentives may at least partly increase the need to regulate household borrowing and to strengthen resilience against risks and vulnerabilities related to residential real estate market. Tax advantages may also strengthen the negative distributional effects and macroprudential measures in the borrowing constraints, if the borrowing constraints reduce the transition from rental housing to home ownership. In Finland, as in most other OECD countries, owner-occupied housing enjoys a tax-favored status. Mortgage interest expenses are often, at least partly, tax-deductible, which makes borrowing more attractive. Real estate or property taxes appear to be low in most countries. The return on owner-occupied housing, meaning the imputed rental income, is usually untaxed, while the return to other financial assets is taxed at relatively high effective tax rate, at least in Finland, where we like to tax different things. Realized capital gains from the sale of principal homes are often tax-exempt, or taxation gains can be referred if by reinvesting in another owner-occupied house. Housing transactions, however, in Finland, typically subject to a transfer tax, which is widely regarded as a highly distortionary measure. Based on existing research, it seems fair to say that transfer taxes and capital gain taxes cause sizable distortions in the housing markets. What have we done in Finland? Finland has been gradually reducing the share of housing loan interest payments deductibility in taxation from 100% in 2011 to 25% to 2019. Tax deductibility is expected to be further reduced or even abolished in the current parliamentary term, starting from this year up to 2023. Tax deduction and the changes to it are likely to have only a small impact in the current low interest rate environment. The reduction may have, however, increased incentives to take and keep housing company loans instead of personal housing loans. This is the Finnish speciality, where you can finance your house through the housing company, not by having the loan personally on your own account. Based on existing research, changes in tax deductibility do have a direct impact on household borrowing. There is research evidence that high-income households reduced mortgage lending and mortgage borrowing after a reform in 1993, which limited their possibilities to deduct mortgage interest payments compared to the control group unaffected by the reform. Transfer tax in Finland is 0% for the first home buyers under certain conditions, for example, such as age. For other buyers, the tax is between 2% and 4%, depending on the type of the house. Transfer taxes are widely regarded as distortionary to the market because they increase the cost of moving, cause lock-in, and reduce residential mobility. Less is known about the potential effects of taxation on price volatility and housing market liquidity. On the positive side, transfer taxes may reduce house price volatility by reducing speculative trading. By increasing the cost of upgrading, they also create an incentive to buy a bigger home at the first place. And on the negative side, thus, this may increase the level of leverage of especially young households. Real estate tax, also known as property tax, is set by the local municipality councils within a given range. For example, in Helsinki, it is only 0.41%, which is the lowest possible. Real estate tax is widely regarded as quite non-distortionary to the market. An interesting question is whether real estate tax could be used to address the differences in local housing market conditions. To conclude, I will briefly recap the role of macroprudential policy and taxation from the central bank's financial stability perspective. Macroprudential policy aims to mitigate systemic risk associated with excessive credit growth and leverage. The measures impact borrowing and thereby also demand for housing. Real estate-related tax policies may in turn either encourage or discourage households to acquire owner-occupied housing and take on more debt. Taxation thereby impacts demand for housing and also borrowing. Different policy measures have different objectives and transmission channels. Macroprudential policies are being conducted by national competent authorities whose aim is to safeguard financial stability and foster long-term economic growth. Tax policies, in turn, are subject to approval by the parliaments where, for example, the distributional effects of the tax reform proposals are subject to a thorough discussion. From the aggregated welfare perspective, it would seem useful to look into the joint effects of the tax system and macroprudential policy in order to identify policy instruments that reduce negative effects of household leverage while minimizing the welfare cost to households. Further scientific knowledge would be welcome, for example, on the distributional effects of different policy measures. Thank you.
So, well, good morning, everyone. Before I start, I'd like to thank, a special thanks to Tomas Garbarevičius for inviting me to speak at this third Bank of Lithuania Financial Stability Conference. As I said yesterday, Tomas always sets the speakers thoughtful and challenging questions, and I think this year's question is particularly challenging, not least because when I started preparing these slides, I really found that the literature on this issue is scant. So I really think that this conference is contributing to closing an important knowledge gap, and so I hope it starts a broader debate on this issue. Let me just say before I turn to the main course of the slides, I have a disclaimer. The views that are expressed in this set of slides are mine and mine alone. Now, to answer the question about whether tax measures can be complements or substitutes for macroprudential measures, I think a prerequisite is that they need to be effective. They need to be effective in achieving financial stability aims. Can tax measures affect financial stability outcomes? So this evidence is taken from a BIS working paper by Banerjee and Sampoli, and it would suggest that it is indeed the case. If you increase the primary balance, so you could do that through tax measures, you will have a fairly significant impact on private sector credit growth. And in fact, I mean, that's kind of enviable in terms of what you would hope to get out of the CCYB. So, I mean, I think that the evidence is there on the slide, but I mean, I think it was also in the presentations yesterday as well, that taxation measures can indeed influence the state of the financial cycle. And I would agree mostly with what you said, Thomas, about this resilience versus taming the cycle. I think tax measures could be useful for taming the cycle. So The plan for my presentation is the following. First, I'd like to make a brief digression on the microeconomics of complementarity and substitutability. And I think it's important for the rest of the discussion. I'll explain why in a moment. Then, with that framework for thinking, I'd like to then look at the links between taxation and macroprudential policy instruments, and then I will complement that with 3 examples of pairings of tax instruments and macroprudential policy instruments, where I try to provide an assessment about whether I think that pairing is a pairing of substitutes or a pairing of complements. So starting with the taxonomy, I mean, my starting point when I was looking into this question about complementarity and substitutability was the ESRB handbook on macroprudential policy. And I think for any analyst that is trying to find out where the consensus is on complementarity and substitutability of individual macroprudential policy instruments, I would recommend there's no better place to start than with the ESRB handbook. Some of you, I think, in the audience here even contributed to that document. Some of you were even involved in the approval and the subsequent publication. It's very thoughtful all the way through on this issue. Now, I don't think that there's much of a controversy really about substitutability. But I do think that there is a tendency to use the term complement a bit too liberally. And so I actually took out, with everything that I have said already about the handbook, I took out 2 examples of text that is in that handbook. One talks about the complementarity between the LTV and the DSTI, and it makes the argument that the reason why they're complementary is because they operate through different channels. Then there is another, later on in that document, it talks about Pillar 2 and macroprudential instruments, and it also talks about complementarity. But this time, notice, it's talking about the same channels. Now, for me, I think it's either one or the other. It can't be both. You can't be a complement operating through different channels and a complement operating through the same channel. I mean, I'll leave it to you to decide for yourself which one of those 2 you prefer. But I mean, I think it will become clear as I go through the presentation. So now, I mean, does it really matter whether instruments are complements or substitutes? Why do we care at all? Well, I mean, I think that the most important from a macroprudential policy perspective, why we should care is because it's important for the assessment of the macroprudential policy stance. It tells us about, you know, whether macroprudential policy is too loose or too tight relative to a benchmark. And I mean this both in the positive sense, the measurement, just simply measuring the macroprudential policy stance, and also in the normative sense, are we too loose or are we too tight relative to some kind of, you know, policymakers' preference about what is the appropriate stance. So, I mean, what are the characteristics of substitutable and complementary instruments? Well, I have a couple of features there for substitutable policy instruments. I think one would say that to achieve the same effect, activating one calls for deactivating the other. That makes them substitutable. The other is that the choice of the instrument should be based on the relative effectiveness. So if you have 2 substitutes, then you go for the one that is going to have the biggest bang for the buck in impacting on the objective that you're trying to achieve. And then as Robert Mundell showed in the 1960s, if assigned appropriately, the need for coordination becomes lower when you do that assignment appropriately. On complementary policy instruments, basically, one way of thinking about it is that activating one instrument enhances the effectiveness of the other. Now here I think, and it came up in the discussion yesterday, the need for coordination starts to arise when pairs of complementary instruments are governed by different authorities, and different authorities that may indeed have different objectives. Now going back to Microeconomics 101, I think it can be helpful in delving a little bit deeper into this substitutability, complementarity issue. I have 3 cases here on this slide with varying degrees of substitutability and complementarity. For each case, there is a single objective, let's call it financial stability, and that's represented by a locus, and so you've got combinations of two instruments that are always giving you the same degree of financial stability, but as you go across, you can see that each has a different shape, depending on the extent of complementarity. Now, above the locus, you have financial repression. You're too tight with the instruments, and below you have financial imbalances. I think to understand the trade-offs, I think it's usually better to start in the bottom left, especially when one gets to the Leontief case. But basically, you can see how much you need to. When you activate one instrument, what you need to be doing with the other when you're underneath the curve. For the substitute case, you can get if you're below the curve, you can get to the curve either by going vertically or horizontally or indeed diagonally. But when you go to the extreme of complementarity, you can only go in one direction, and that's diagonally. And that is basically that you get effectiveness coming from one instrument, enhancing the effectiveness of the other. Now, those were clear-cut cases, but I think in many cases, instruments can be, for certain calibration settings, complements, but for others, they can be substitutes, but they can also be complements, depending on the settings. Let me give, for example, the ESRB handbook makes special reference to the case of where you have either arbitrage or leakages. And this is a case where those arbitrages or leakages reduce the effectiveness of the instrument. For example, the debt service to income limit can be circumvented by, I mean, it was discussed earlier, by lengthening the limit of by lengthening the maturity of the loan. So then, how do you deal with that? Well, then you impose a maturity limit. So that's one example. But I think that there are plenty of others as well where you get this, where you get leakages. So how do we classify pairings of instruments? So this is a proposal from that comes out of the work that I have been doing in the preparation of this presentation. I think you need to go through a sequence of analysis looking at the objective, the transmission, and also the degree of how mutually reinforcing or not the instruments are. So as I had on my first slide, I think key is whether the instrument has the capacity to influence the desired outcome, the objective. For financial stability, this is not always straightforward because we don't have a single measure of financial stability. We have a multitude of them, and many of the presentations today and yesterday were looking at different measures for financial stability outcomes. Also, the transmission mechanism is important. Do the taxation instruments, for example, operate through the same transmission channels as the macroprudential ones? So if it's yes, I think one example would be LTV down payment versus stamp duty. Thomas, this is what was also in your slides. There you have substitutability going on, but you can also have transmission complements, where you also talked about it, domestic versus foreign investors in the application of a stamp duty. And of course then, even when you've done all that on the transmission, you want to know whether there is whether the instruments are mutually reinforcing or not. And that's basically looking at the partial derivative of the effect of one of the instruments on the desired outcome, and then what happens to that derivative when I change the other instrument. And depending on the sign, I either have a complement or I have a substitute. Now, with that preamble out of the way, let's turn to the links between real estate taxation and macroprudential policy instruments. Denise had a Venn diagram yesterday. I have one as well. It looks a little bit different, but and we had I think a good discussion on this, and it's giving me cause to reflect about, especially the extent to which these two overlap. I mean, tax authorities though clearly have different objectives to macroprudential authorities, and the overlap between them actually may not be that well. Okay, I mean, we don't have to take the dimension so seriously, but I think on the other hand, fiscal policy it must be at least in part set for moderating the business cycle. So I don't think that the overlapping set is a null set. I mean, there has to be an overlap between the objectives of macroprudential policy and taxation policy, in my view. Transmission mechanisms. Thomas, you had a lot on the individual tax measures, so I don't need to go through them in detail. But the range of tax measures that can influence financial stability outcomes is wide. I mean, I have the list, a list on the left. I mean, it's not an exhaustive list, so that there are taxation measures on income, financing transactions, wealth, supply, production even. Also, macroprudential policy, we have a range of instruments as well, borrower-based, contract-based, lender-based, and asset-based. And they all, and I think that these two sets of instruments can operate through the different transmission channels that are in the center. I'm going to do one mapping exercise in a moment, just to show that it's actually rather complex to look at the mapping of the transmission between two sets of instruments. But first, what does it mean for policy instruments to be substitutes? Now, this is a thought experiment that I had, that I used 2 years ago when answering the question about should macroprudential policy be used to moderate to target house prices. I'm having a little bit of cause for reflection on the basis of what we've been discussing on property taxes on the left-hand side. But the idea here is simple. You've got two objectives, and you've got two policy instruments, and each of those policy instruments are substitutes for achieving the objective. So in one case, we have an objective of house price stability with property taxes or macroprudential policy, and then we have debt sustainability. So two different financial stability type objectives. And then the two instruments have relative effectiveness in achieving those. Now this borrows a bit from the framework of Robert Mundell that I mentioned earlier, and we'll just make one assumption for this thought experiment, and that is that property taxes have a bigger impact on house prices than macroprudential policy does. So putting the two of them together, then there's a point where both objectives are achieved at the same time. That's point D there. You've got mutually consistent policies. But now suppose we start at A, where we have debt sustainability but not house price stability. So responding with macroprudential policy, that would be moving to B, would actually be the wrong decision here. It would stabilize house prices, but it would create a credit crunch at the same time. And in fact, you go off in a kind of a destabilizing direction. Mundell showed this analytically a long time ago, but the point is that inappropriate assignment can actually lead to destabilization of the economy. So let me turn to the three examples. So first, the first example that I want to look at, Thomas, you were looking at as well, LTV and stamp duty. And as I said, here's a promised mapping of transmission. So both of them have an impact on credit flow quantity, I think, and both of them have the impact in the same direction. Now, you mentioned that taxes don't have an impact on resilience. Well, I mean, actually, I think you could make an argument that levying a stamp duty on households actually reduces borrower resilience, whereas the LTV is enhancing borrower resilience because it's creating an equity buffer on the balance sheet of the household. And then on the asset itself, on collateral, arguably you would expect a negative effect, but we saw some empirical work yesterday that wasn't actually suggesting that to be the case. But the question is, or the issue is, which of those objectives is the one that you're aiming for? Because as you can see, it depends. The signs are positive at the top if it's credit flow, and that's what you're worried about from a macroprudential policy perspective. Then they're substitutes. But when you have opposite signs, they can indeed become complements. Now, the objective of the two instruments, as I said, are also very, very different. Stamp duty has primarily the purpose of raising revenue, but it could be used also to reduce housing demand, while also, by the way, and maybe this comes back on the resilience question, you could build up a rainy day fund for the sovereign from the collection of stamp duty taxes, and then you're back to enhancing resilience, although you've moved it elsewhere in the economy. So I think a kind of a general equilibrium way of thinking is needed to answer this question in a comprehensive way. The LTV objective is clear, and it lowers the loss given default rate for the banks because it has created this equity buffer for the households. But perhaps I think the most important difference between the two, and this is where the issue, I think, where we can, I hope to get to an answer on complementarity or substitutability, is on the scope. The stamp duty applies to all investors, foreign and domestic. The LTV, unless it's reciprocated, applies only to domestic investors. So there is a leakage here on the LTV, and I think that makes this pairing a candidate for complementarity. Stamp duties, in fact, have ambiguous financial stability implications, in my view. On the one hand, you could dampen house price inflation, but it's also raising, effectively, borrower leverage. But they can complement the LTV under certain conditions, especially if they're targeted at foreign investors, as they cover. They're covering basically a group of participants in the housing market that is not covered by the LTV. So that, I think, provides scope for complementarity. Now, the second example, this was mentioned a bit yesterday, so I think I can go through this quickly, but both in Hong Kong and in Vancouver, property prices have been going through a boom for many, many years. And authorities in both jurisdictions have been taking a variety of measures to try and contain them. Macroprudential measures, but also tax measures. Here's a chart that I took out of a study that was done by the Hong Kong Monetary Authority, and here you can see rounds of macroprudential policy measures when they successively tightened. Since 2009, the LTV, and the LTV now is, but the figures are there on the bottom right, but it's now reached 60% for domestic on a first home borrowers and 40% for foreign buyers. But it didn't start there. I mean, it came down progressively from the numbers that we're more used to in Europe. But just last week, the Hong Kong authorities announced new tax measures on the Hong Kong property markets, in particular a tax on vacancies. I tend to see this as a measure that is aimed at stimulating supply. Interestingly, the market reaction, it's all we can take for now about what is likely to be the impact. The Hang Seng, the property sub-index of the Hang Seng index came down by 1.3% on the news of this. So I think in principle, again, for the argument that it's operating through a different transmission channel, I think that this is likely to be a complement to the macroprudential policy measures that the Hong Kong authorities have been introducing. Also in Vancouver, they've done the same, first imposing on the tax side, in addition to the macroprudential measures, first imposing a tax on foreign buyers, then last year a speculation tax, and a vacancy tax rate was also implemented in Vancouver. With higher rates for foreigners, as you can see there as well. And from the chart, it looks like these measures are working because you can see that house prices, that's the level, have even come down a bit since they've been implemented. So again, I think there's a case can be made here of complementarity of these tax measures together with the macroprudential ones. Last but not least, we spent a lot of time on it yesterday, even more time on it today, and I think we're beginning to arrive to conclusions on this issue, the issue of mortgage interest tax relief and its interplay with macroprudential policy measures. There was a very careful analysis that was published by Summer and Sullivan in the American Economic Review last year, simulating the impacts of an elimination of the mortgage interest relief in the US. and what would happen in that case. And the impacts are, it's summarized there, reduces house prices, it reduces mortgage debt, so also loan to value and loan to income, not the limits but the levels. And then it also, by the way, it improves home ownership and it raises welfare. Some kind of, well, there were some counterintuitive findings that came out of that, because you were talking earlier, Klaas, about having tax deductibility as a measure to improve home ownership. Apparently, elimination of it in the US could also raise home ownership. So it's just one study, and I know that, yeah, but I mean, the findings of Summer and Sullivan were also corroborated in another study that I managed to find by Hendershot, Price and White, where they also find this impact on house prices, that eliminating tax deductibility reduces house prices. So it basically looks like, I mean, to me, macroprudential settings could be looser when you have when you eliminate the mortgage interest tax relief. So basically, there's a trade-off. You could have an LTV that you could allow the LTV to be higher if you eliminate mortgage interest tax relief. So what does that basically mean? It basically means, to my mind, these are potentially substitutes. So let me wrap up. So we were asked a very specific question, and my answer to that question is, it depends. Complementarity or substitutability. But really, I think we can also think about a framework for figuring out what those dependencies are, to see whether or not we do have indeed substitutes or complements. So of course, the first question is the objective the same? I mean, I really mean, and we need precision here. You talk about resilience, moderating the cycle. We could be even more precise, but it's really about it's all about the objective. Then the question, is the transmission different? If it's different, they're likely to be complements. And then, is there mutual reinforcement? Again, if it's the case that activating one, you know, the LTV and the LTI, for example, people often use as, they have different transmission channels and there's mutual reinforcement, and so you get complementarity. Right. I think, I mean, also from the presentations yesterday and today, I mean, we've seen that many tax instruments can influence financial stability outcomes, but I think very little is known about how they interact with each other, either theoretically or empirically. And this is why I think this conference is very good for triggering a debate on this. My tentative conclusion is, where there is complementarity, the case for using tax instruments to achieve financial stability aims is strongest. So if you have a leakage and your macroprudential policy instruments are not able to reach to a certain segment, you can do it with tax, but only really as a last resort, I would say. And then my other conclusion is that spillovers between the policy domains call for coordination. I mean, I think on the financial stability side, we could do a lot more on carrying out financial stability impact assessments of tax measures at the very minimum. So I'm going to leave it there. Thank you very much for your attention.
Speakers, where would you prefer?
Girl boy.
You can do the same order.
The way we spoke, okay, in the order we spoke.
Okay, is this the order?
Yeah. Okay, thank you. To simplify.
Yeah,
okay.
Yes. We alternate. All right, so I hope everybody enjoyed as much as I enjoyed from this very clear and thought-provoking presentations. So, if okay with everybody, well, since I'm the chair, I can do what I want, I guess, in this case. I have a few questions that came to mind as I was listening to the presenters, and I want to open with those, and then we're going to get questions from you guys. So my first question actually to Mario, when you mentioned limitations of macroprudential policies, you mentioned that when there are regional differences, it may be difficult to apply them because they are applied consistently nationwide. And that kind of goes counterintuitive in the discussion between monetary and macroprudential policies, where we think of monetary policy going into all the cracks, and macroprudential policy being more surgical, more targeted. Could you explain a bit more what are the obstacles that it cannot be applied to certain regions, cities, neighborhoods?
Yeah, I would leave the monetary policy aside, but when coming to macroprudential tools and measures which we have available in Finland, they are used on national level, and as you saw in my presentation, the housing market in Finland and the price development, and also the potential bubbles, that varies between regions. And for example, Helsinki metropolitan area is one region where the prices have been growing, and in some areas quite rapidly. On the other hand, in some parts of Finland, it is very stagnated, or even the price levels have been going down. So in that sense, it might be worthwhile investigating where it would be possible to have these macroprudential tools used in a more regional on a more regional basis. But at the current stage in Finland, the legislation is for the whole country, and when the averages don't tell much, then of course it creates a challenge for using the tools.
That was interesting, at least for me too. It was a new piece of information, and I think it goes to yesterday when we started the conversation. Obviously, everybody's excited about the topic, real estate taxation and the interaction between macroprudential policies. But yesterday, we also opened up saying that there are other policies, structural policies, legal frameworks, institutions that can be interacting with macroprudential policies. Perhaps topic for the next conference. We'll see how that's going to go. But now let me move on to the real effects, the regional differences that were mentioned, and John also talked a little bit about the real effects, the channels, transmission channels, how these things would work. And yesterday, in Thomas's presentation as well, we talked about in Lithuania, in other countries, rural versus urban differences and mobility. So my question is about this real effects channel, if you would. How do we think about this in the current frameworks? How does macroprudential policy affect consumption? In our keynote speech, it also came up. You had a chart on household debt and consumption responses during the crisis. Do we have a framework? Do we consider them in our policy making? What type of real effects happen? Whether there are misallocation implications from macroprudential policies, regional differences, inequalities, distributional effects. How do we consider them in the current frameworks?
I mean, I think, well, on some of the allocational issues, the side effects of macroprudential policy on allocation. For example, the literature is starting to show that macroprudential policies can have impacts on where people live, on the place that people live. And the macroprudential policy can cause people to migrate, to move. I think there was a lot of evidence provided by a colleague from the Bank of Israel, Nitzan Sur Ilan. She had a very thoughtful study on this in the case of Israel, and showed how borrower-based measures can lead to movements of people to different parts of the country. We don't look at that, I think, in macroprudential policy assessments ordinarily. Maybe the reason we don't is because it's not really part of the overall, thinking on the objective. I mean, in the end, okay, it's a spillover that is influencing perhaps another objective, social policy objective, I don't know what, environmental. So I'm not sure if it's, I mean, I think it's useful and maybe indeed important to know, I mean, also for the political consequences of the activation of macroprudential policies. But I don't think it should be necessarily a deciding factor in the setting. Because it's not really part of the overall, the objectives of resilience and moderating the cycle, as I think of it.
Yeah. Okay. So we're a bit more fortunate in Lithuania compared to Finland because we have more flexibility here. If need be, we actually could go regional and to apply our instruments on a regional basis. Actually, we're even collecting some information on regional basis. But the reason to intervene would need to be related to financial stability concerns. Because other concerns, it's a global trend that, urbanization is strengthening, people leaving from smaller cities, they migrate to big cities. What could be done? It's also a political issue. So I think it's more for fiscal policy. But at the same time, which is different actually, OECD statistics tells a different picture, but I think in Lithuania, the recurrent property tax is national. It's not for municipalities, it's more for commercial property. And in this regard, fiscal policy in Lithuania would be difficult for them to address these sort of regional issues. But as I said, it's a bit different object, as John mentioned, it depends on objective. If it's financial stability concerns, misallocation of resources, something is happening, for example, in the capital city, but it's not in the rest of the country, we could react accordingly. And I think we should address the source of risk, and that flexibility is available in our case, and I think if need be, we could definitely consider it.
And regarding the impacts of using macroprudential tools, I think that macroprudential policy is quite new. So we have to learn and understand more, and we have to investigate and try to make impact assessments when considering of using macroprudential tools, but also backtesting in that what are the consequences of having certain macroprudential tools in place. The challenge, of course, is that it could be quite difficult to isolate the impact of using macroprudential tools, because they are not used in a laboratory. They are used in a real world where there are different kind of factors and parameters affecting to the whole economy. So, but I think that we should be able to become better in understanding the interlinkages and the joint effects of using macroprudential tools, and also if leaving the macroprudential tools unused.
We could learn actually from examples in South Korea and Hong Kong. I'm sure you know that they tried to react in this way.
Right, one last question, going to that again. So what I'm hearing you guys is that first there are more things to learn in terms of the effects and understand better. But also at the same time, given that there are going to be circumstances where these measures, taxation and macroprudential policy, are going to be complements or substitutes, how do we coordinate, or do we need to coordinate?
As I mentioned in my presentation, we take the taxation as a structural phenomenon, so we take it as a given. But I think that as a part of the impact assessments, I think we should also take the taxation and even the tax reforms into consideration, so that we also there improve our possibilities for prudent policy making.
For me, yeah. Coordination. I think for the time being, I still have the view that macroprudential policy, the central bank is the best place to conduct macroprudential policy, given that macroprudential policy operates largely for the credit market, and also monetary policy transmission is also largely for the credit market or other transmission channels. And the central banks, in my view, are best placed to sort of competence centers actually to analyze these issues. In the case of fiscal policy, there are obvious candidates. There are a few definite, simple, like mortgage interest deductibility, some easy gains to be done, sort of to ensure. But for other, like actively changing property taxation, maybe stamp duty, we're not there yet. If we come to that point that actually fiscal authorities become more proactive, and they sort of also start thinking in a macroprudential way, then I think we could consider some closer cooperation, but we're clearly not at that point yet. So when it comes, we could think maybe some more intense cooperation.
I think, well, we spoke about this yesterday a bit as well. I mean, about the political challenges to coordination between, on the one hand, is primarily central banks on the macroprudential policy side, and fiscal authorities, finance ministries on the other. So I'm not sure that an explicit cooperation, I think it would be challenging to arrange an explicit cooperation, but I think that need not necessarily prevent the dialogue, and the dialogue, I mean, in both directions. so to speak. I mean, I think macroprudential authorities could be bolder in calling out, you know, when tax measures are undermining financial stability objectives, or indeed, as we have seen in some instances, countervailing macroprudential policy actions, where a fiscal authority tries to compensate for, I don't know, the loss of access of a certain group of borrowers from the market by providing a tax subsidy or a tax benefit in some respect. I mean, I think in those cases, then, I mean, the macroprudential authorities have a duty to call it out.
All right, so we have 15 minutes, a bit more than 15 minutes. Any questions from the audience? Yes.
So, hello, Vaidotas Šumskis from Bank of Lithuania. So, first of all, thank you for all the presenters for very interesting presentations and eye-catching presentations. So, I would like to ask you to express your views on the rental market regulation. So, for example, the rental market is regulated quite often across various European countries, for example, in Germany, in the Netherlands, in the Nordic countries, and it is neither macroprudential tool nor fiscal tool. However, rental market regulations, for example, capping the rental prices, the regulations affect the expected returns of the landlords and in turn affect the demand of housing and as well affect the prices of residential properties in one way or another. So my question would be just to express your views on the potential interactions between rental market regulations and financial stability and macroprudential policies. So thank you.
Beautiful question.
Yeah, I can start. You're probably referring to the cases in Germany, Berlin case, the most recent case when authorities intervened into the market. I'm more familiar with the Swedish situation. Indeed, could be a structural feature which might have quite an impact on the housing market. But I think it's not for macroprudential authority. It's probably more for sort of politicians to solve this issue. But nevertheless, as a central bank, sort of from macroprudential perspective, we could advise and sort of discuss various options. That this is most we could do probably in this particular case.
Yeah, when it comes to rental market regulation, I think that is quite national. And when thinking from the Finnish perspective, when lending is used, when these second and third homes or houses are bought for rental purposes, then there are same regulation as goes for homeowners, for example, LTV regulations and the recommendations which I mentioned in my presentation given by the board of the FinFSA. So in that sense, it is there. But there are some phenomena in Finland, for example, which make which in a way encourage normal households to buy second and third houses in order to rent them out. And one, for example, is of course the low interest rate level, and also the possibility to not only to deduct the interests which are paid for interest costs for loans. You can deduct them from your rental income, and you can also deduct in certain cases also the amortization of the housing loan which you have taken for the rented apartment, for example. So in that sense, there are some incentives now, and that is one thing which we have been quite concerned about. We see that there's a link between having this kind of rental activity and also the household indebtedness. So there is a connection, and I would be quite cautious when we are talking about increasing the amount of rental apartments by using leverage. So in that sense, there's a connection to financial stability.
Yeah, just one more remark. When I thought actually these regulations restriction on the rent caps could be very detrimental for financial stability, because this in a way promotes ownership. And then when it's a structural demand, sort of strengthening structural demand for owning rather than renting. And given my framework, it's very bad. So Indeed. So here, some regulation is needed, but probably caps, I find it a bit extreme.
Yeah, and if I may continue, I also agree that it's important to have enough opportunities and alternatives, not only to buy a house, that you can also live and rent an apartment, rent a home, and that's why it's important that they are houses and homes provided by the society, but also from the private market. That is important. But when it's a very leveraged business, then there's a risk.
Yes.
Okay, I mean, I agree with everything that was said already. I mean, one thing, I mean, I don't like it because it's a distortion on the market, and I mean, ultimately, what it's going to do is it's going to reduce the supply of new homes. So it has a financial stability implication. Your question is whether macroprudential policy should respond to that or not. I mean, I guess it depends on whether it sets in motion a dynamic. You know, an adverse dynamic and building up of a bubble or so, which, depending on the circumstances, it could potentially do that. So I would, you know, answer that cautiously. But yeah, I mean, if it led to a house price spiral, for example, and a increase in leverage, I mean, I think then macroprudential policy has to respond. But the best thing to do would be not to have it not to have the rent control in the first place.
Other questions? Yes.
Dubravko Mihaljak from the BIS. We've heard a lot this morning about the dangers of household debt, of tax system that provides incentives for home ownership. I understand where this is coming from. But let me, for a moment, take off my central banking hat and put on my public finance hat. Is the main problem the tax system or the low interest rate environment that encourages debt? That's one question. And second thing is, things are not so black and white. And there are good social stability reasons to promote home ownership. And then, again, is the problem the tax system that provides incentives for home ownership? Or is the problem the financial system? And let me elaborate a bit. If you own small business, there's no way that bank will give you a loan unless you pledge collateral. And the only collateral that banks accept is a home. So by saying home ownership is getting unfavorable treatment, you are indirectly also saying, well, we are going to restrict access of small and medium-sized firms to bank loans. And this may have consequences for output growth, for productive activity, and so on. So, in a way, you could argue that the real problem is that banks are lazy. The only thing they care about is security, and they will readily take property as a collateral, but they don't want to spend their time assessing credit risk of small and medium-sized firms. Then you could also argue we need better capital markets to solve this problem in the long term, because then even small firms could issue debt, issuing debt equity would be easier, and so on. So these are some comments, but I'd like to hear your reaction.
Right. Thoughts on low interest rates and collateral channel, I guess.
If I may start, I think that from the we have done quite a lot now with the tax system. So the current current government, which just started its work and created finalized its program, will reduce the deductibility and abolish it. That is at least their target. So I think that for Finland, the main challenge, I would call it a problem, is the low interest rate levels. Good social reasons for promoting house ownership. I agree to some extent, but on the other hand, I'm a level playing field person like Thomas in his presentation. So I would say that affordable housing is the thing, and I think that we have some quite alarming examples from the past, not so far away, where there was a social and political program of incentivizing people to buy houses which they couldn't afford, and I'm referring to the subprime crisis in the US. But one thing which we should not promote is the over-indebtedness of households, because there's clear evidence that high household indebtedness is a clear symptom and clear signal of coming financial crisis. SME financing, I agree, we should promote capital markets union, and since Finland is now the EU president, we have the EU presidency, I think that topic is on the agenda.
On the interest rate one, so I don't agree with that. I don't think that low interest rates is the explanation for an increase or for higher home ownership rates. I mean, when I look across the countries, I don't know who had it in the slides, but Germany has a below average rate of home ownership, yet it is the country of Europe that has had price stability for the longest and the lowest interest rates for the longest as well during that time. By the way, I think there is an interaction between the level of interest rates and the tax deductibility of mortgage interest. Of course, obviously, that benefit becomes lower as interest rates are lower. So again, if that's a factor that was driving home ownership, it's working in the opposite direction at the moment as well. I think the explanations tend to be more cultural than anything else. I mean, home ownership. I mean, there are. The development of the rental market, of course, is a factor as well. But in my own country, for example, it was always, the most important thing for any adult to save for buying their own home. And I mean, that has a kind of a contagion effect, I think, across. I mean, just people basically plan for that. And I think that it's more the macro factors that matter in the end, whether somebody is going to take out a mortgage, probability of unemployment, and that depends on the stability of the economy, which in fact price stability brings. So I wouldn't necessarily agree with that idea. On capital markets union, I don't think I would. The ECB is a big supporter of capital markets union. I don't think there's anything that I would add to that. I think it needs to be promoted. It's needed, and especially for getting finance to parts of the productive parts of the economy that are likely to be delivering profits in the long run.
Yeah. So interest rates or taxation, you can't deny interest both have an impact. Relative weights, it's an empirical question, but yes, this is a law of in a way how things work there. On other issues, I think a case could be made, that housing is a necessity. It's also a consumption good. And for primary residences, you could make a case. And actually, in many countries, you have exceptions for first-time buyers. But at the same time, it can happen well that you simply increase demand. Some people, if they could prefer to rent, but then we encourage them nevertheless to buy. And what happens? You strengthen demand, and ultimately, what happens? Prices go up. And it becomes more expensive, and in a way, you reach equilibrium, which is not desirable. So any deviation from a neutrality might have an implications. You go into another equilibrium. Whether banks are lazy, it's how the whole system works. I mean, the whole banking sector is reliant on collateral, and which is usually real estate, commercial real estate, residential real estate. This is how it is, and actually, this is another support, big structural support for the market, the real estate market. And well, if you need somewhere to live, so if you rent, you can get a consumer loan to buy those services. But if you own, well, it's additional security for a bank. If a bank is asking for that collateral. So here, it's a big issue, I think, but to call banks lazy, I would need to have a second thought on that.
All right, there was one more question there, Francesco, I think. We'll need to get 10-second responses.
Thank you so much. I'm Francesco Zallino from Bank of Italy. I'd like to bring in the discussion the idea that was just put forward in the assessment framework recently adopted by the SRB and the macroprudential to consider both the benefit side and the cost side on policies. So just coming in the direction of your question before. In this view, I wonder if the discussant could consider the merit to extend the discussion of complementarities or substitutabilities between macroprudential and fiscal, also in the cost dimension, in such a way that perhaps we can help the communication and also help gaining consensus in tax reform. So if you just say that reforming the tax system could reduce the social cost of the needed macroprudential policy. So I wonder if you think it could be a good strategy to also help to start understanding also complementarities, not only in terms of benefits, but also the expected intended and unintended cost of the macroprudential action and of the fiscal action in order to see if we can improve communication in this respect.
Yeah. Well, these two gentlemen were talking about the supplements and complements. More than me, I said that they have to interact. I'm not an economist, I'm a lawyer, so I say that yes, both, yes and no, and when there are two lawyers, there are three opinions as well as it's the same with economists. I would say that I would be cautious in giving guidance and giving some kind of recommendations to the authorities and institutions responsible for deciding and planning and implementing fiscal policy. But I think that what central bank can do is to assess the consequences, and as I said in my previous comments, that it would be very important to have an impact analysis, not only for using different macroprudential tools, but also the understand and analyze the interlinkages between tax policies and also the macroprudential tools.
So in Lithuania, we are in a bit different situation, a small country and probably
Finland's a big country.
True. And I think if something is happening, there are not so many economists. And in the central bank, we are in a situation, like the governor said, we have the largest number of economists per square meter. And we cannot stay aside if something is happening in Lithuania. So our position is that we will try to be proactive, we'll provide opinion, even if we're not asked on the key issues for Lithuania. It's a bit different from other countries. You know, you prefer to stay away from issues which are not related to central bank. But in our case, we have a bit more proactive attitude. And we think it's important for the country. So if we have an opinion, we have something to say, we'll say it if needed. Yeah.
My 10 seconds on that. I mean, I think there's a very long tradition of monetary policy makers sharing opinions on fiscal policy. So, I mean, I don't think that there should be really any hesitation on the side of macroprudential policy makers to do exactly the same and call out when fiscal policy decisions are potentially adversely contributing to the financial stability objective. Absolutely. So I agree. Yes.
Right. We are out of time, but during the coffee break, I'm sure the discussion is going to continue. Give me a hand in thanking the speakers, and thank you for your patience and interaction with the speakers. Thank you, everyone.
Thank you.
Sveiki susirinkę visi į trečią kartą Lietuvos banko organizuojamą makroprudencinės politikos konferenciją. Šiemet tema buvo labai įdomi - nekilnojamo turto apmokestinimas ir makroprudencinė politika. Tai ilgai nedelsdama perduodu žodį Lietuvos banko valdybos pirmininkui Vitui Vasiliauskui ir mūsų svečiui iš Nyderlandų centrinio banko vadovui Klaas Knot.
Tai gal aš trumpai tada iš tikrųjų, tai kaip ir minėjo kolegė, pabandėm apjungti tokius du topikus, tai yra apmokestinimą ir makroprudencinės politikos priemonės, kaip jos gali bendradarbiauti, kaip tai gali veikti nekilnojamo turto rinką. Na, iš principo tai yra iš tikrųjų nauja tema, mažai nagrinėta ir kalbant apie nekilnojamo turto apmokestinimą, aš manau tikrai aktuali Lietuvai. Tai, na, matysim, koks bus rezultatas konferencijos, bet aš manau, na, diskusijos jos visą laiką yra labai svarbios. Tai tokia trumpa įžanga gal ir mielai tada atsakyčiau į klausimus.
Nekilnojamo turto mokestis Lietuvoje kokį vaidmenį turėtų atlikti?
Vėlgi, tai žinot, tai yra senai keliamas klausimas iš tiesų ir mes pasiūlymus nekilnojamo turto apmokestinimo sistemos esam davę, dar kartą sistemiškai pateikę dar praėjusiais metais. Mes nuolat gaunam rekomendacijas iš tarptautinių organizacijų, tai pradedant Tarptautinių valiutos fondų, taip pat kiekvienais metais faktiškai kalbam apie gaunant tai iš Europos komisijos. Na, nekilnojamo turto mokestis yra neutralus iš principo mokestis, jisai mažiausiai, vadinkim taip, žalingas, lengviausiai administruojamas, todėl tai yra papildomas pajamų šaltinis, o turint omenyje mūsų perskirstimo lygį, aš manau, tai būtų tikrai neblogai turėti kokį klasikinį. Bet vėlgi, aš sakau, čia be abejo yra vykdomosios valdžios prerogatyva. Mūsų noras būtent buvo padiskutuoti, o kaip tai koordinuojasi, kaip tai tarpusavį įtakoja su makroprudencinė politika. Kaip žinot, mes esame atsakingi, mes kaip Centrinis bankas būtent esame atsakingi už tas į kreditą nukreiptas priemonės, už jų įgyvendinimą.
Aš atsiprašau, perduosiu visą mikrofoną, nes kadangi turim tiesiog netransliaciją, tai kad visi girdėtų.
Tai, ponia Vasiliauskai, iš makroprudencinės politikos konteksto žiūrint, ar yra kokių nors terminų, kur jūs siūlytumėt nekilnojamo turto mokestį išplėsti ir taikyti jį plačiau, paskubėti galbūt, o jeigu jo nepritaikysime, galbūt matote kažkokių rizikų? Ačiū.
Žinot, nuo savo ankstesnio gyvenimo, kurį aš dalį jo praleidau viešuosiuose finansuose, tai nekilnojamo turto apmokestinimo koncepcija ir pats mechanizmas jau senai buvo paruoštas ir jisai, na, guli toliau stalčiuose, ta prasme. Tai mes savo pasiūlymus pateikėm pernai metais, tai yra dėl bazės išplėtimo. Vėlgi mes nesam kosmonautai ir puikiai suprantam, kad dabartiniam politinio ciklo etape matyt, na, sunku būtų kalbėti apie kažkokį bazės plėtimą. Na, bet Centrinis bankas yra maratonininkas ir, na, mūsų misija yra pastoviai kartoti dalykus, kurie mūsų galva yra svarbus. Na ir be jokios abejonės, čia reikia susitarimo. Mes tikimės, kad kitam politiniam cikle bus grįžta būtent prie šitų pasiūlymų.
Įvertinus tarptautinių organizacijų rekomendacijas ir Lietuvos padėtį, koks Lietuvos banko įsivaizdavimu kas tokie turėtų mokėti nekilnojamo turto mokestį, galbūt tarifą, konkretų skaičių numanote?
Žiūrėkit, aš nenoriu nerti iš tikrųjų detalės, bet bazė platesnė, apimanti iš principo gyventojų nekilnojamąjį turtą. Ir tarifas diferencijuotas priklausomai nuo nekilnojamo turto vertės. Tai, na, tai sakyčiau, ašis galėtų būti, bet vėlgi sakau, čia reikia pirmiausia susitarimo ir na, bendrai sutart, kad, na, tai yra reikalinga, kol kas, na, sakau, matyt, šiame etape diskutuoti būtų pakankamai sudėtinga.
Kaip žinom, praeitais metais surinkta vos 2 milijonai eurų nekilnojamo turto mokesčio, tai yra pakankamai niekiniai skaičiai, remiantis kitų Europos valstybių patirtimi idealių atvejų, kokia būtų siekiamybė, kokią maždaug dalį valstybės biudžeto galėtų sudaryti nekilnojamo turto mokesčio dalis maždaug.
Tai šiaip nekilnojamos nekilnojamo turto mokestis klasikinė prasme yra savivaldybių mokestis arba vietinių valdžių pajamų šaltinis. Vidurkis, OECD vidurkis yra maždaug 1%, galim palyginti maždaug su mūsų kaimynais. Tai Lenkijoje tai yra maždaug 1,2%, Latvijoje tai yra maždaug 1%, arba konkrečiau 0,9%. Na, pas mus dėja mes smarkiai atsiliekam. Tai va, jums galėtų būti ir palyginimas, kaip turėtų būti.
Čia savivaldybių biudžeto ar bendro valstybės ir savivaldybių kartu?
Čia mes kalbam skaičių nuo bendro vidaus produkto.
Bet Lietuvoje turbūt, jeigu atsirastų statesnis ant mokestis, jis būtų keliauti valstybės biudžetas, nei savivaldybės, ne?
Čia vėlgi, kai pasirinktumėm klasikinę prasme, tai yra savivaldybių biudžeto dalis ir dabartiniu metu tai yra savivaldybių biudžeto dalis, išskyrus tą dalį už brangų nekilnojamąjį turtą, kuris papuola būtent į valstybės biudžetą. Bet šiaip klasikinė prasme visą laiką tai yra vietiniai mokesčiai.
Ir šiuo metu kokia dalis Lietuvoje yra? Būtent valstybės savivaldybių biudžeto nekilnojamo turto.
Didesnė dalis eina be jokios abejonės į savivaldybių biudžetą. Bet čia įskaitant ir komercinį nekilnojamą turtą ir gyventojų nekilnojamą turtą. Be abejo, gyventojų nekilnojamo turto ta dalis brangesnė, kuri patektų į valstybės biudžetą, patenka į valstybės biudžetą, yra pakankamai maža dėl to, kad neapmokestinimas minimumas yra didelis iš tikrųjų. Ir kaip jūs ir minėjot, bendra suma nesiekia net ir 2 milijonų eurų. Tai iš tikrųjų yra visai nedaug.
O nekilnojamojo turto mokesčio vaidmuo, apsisaugant nuo krizės, stabilumą mūsų užtikrinant, koks tai yra vaidmuo?
Na, tiek nekilnojamo turto mokesčio, tiek apskritai kitų mokestinių dalykų, pavyzdžiui, palūkanų lengvata, pavyzdžiui, įvairios gyventojų pajamų mokesčio lengvatos susijusios su pirmuoju būstu, su turto vertės padidėjimo pajamomis. Na, tiesiog yra įrodyta, kad jos prisideda prie kainų nestabilumo suvaldymo iš tikrųjų. Tai be jokios abejonės laiku jas įgyvendinant padėtų išvengti nekilnojamo turto burbulų susiformavimo. Tai galim paminėti ir mūsų istorinę praeitį, ta prasme, kai turėjom 2002-2008 metais turėjom palūkanų lengvatą. Tai jeigu jinai būtų buvus panaikinta anksčiau, mes manytumėm, kad tai būtų daugiau paveikę į burbulo netokio dydžio susiformavimą, taip sakant.
Tai dabar čia finansinis tas ciklas baigėsi, tai galima sakyti, kad plačiau taikomas mokestis būtų kaip toks vienas receptų, kaip išvengti mūsų ekonomikai didelių padarinių.
Vėlgi, tai yra lengvai paimamos pajamos ir taip pat tai yra stabilizuojantis veiksnys.
Jonas Deveikis, LRT, čia klausimas. Norėjau paklausti, kaip manote, nekilnojamo turto mokestis universalus ar galėtų padidinti ar pamažinti kainas nekilnojamo turto?
Iš principo, vėlgi, priklausomai nuo savivaldybės. Tai aišku, ten, kur aktyvumas didesnis, o šiuo atveju mes kalbam labiausiai turbūt apie Vilnių, Kauną, Pajūrį, prasme, tai be abejo prie netokios intensyvios kainų vystymosi dinamikos tai prisidėtų. Atsakymas turbūt toks, suprastas atsakymas turbūt turėtų būti taip, tai įtakotų kainas.
Ponui Natui klausimas, ar galėtumėt pasidalinti savo pavyzdžių Nyderlanduose, kaip yra su nekilnojamo turto apmokestinimu ir galbūt yra rekomendacijų iš jūsų pusės Lietuvai. Gal matote tam tikrų probleminių taškų arba pasiūlymų? Ačiū.
Well, thank you very much for this question. As I also noticed in my introduction, actually a lot of the lessons that one can draw from the Netherlands have already been drawn in Lithuania, in terms of the abolition of the mortgage interest deductibility that has already been completed here in 2009. and also in terms of lowering the caps on the loan-to-value ratios, which is effectively 85% here in Lithuania, whereas in my country it's still 100%. Both in my country both elements have led to excessive dependence on mortgage indebtedness for home ownership, and that has led to a lot of, let's say, additional amplification of the macroeconomic cycle, amplification of the business cycle. In my country, it implied that in the run-up to the financial crisis, that growth was consistently higher than in surrounding countries. But after the crisis on the housing market, the recession in the Netherlands was deeper than it was in other countries because of this additional effect on private consumption. And that's a reason why the theme of the conference was about complementing or substituting macroprudential and taxation. But in the Netherlands, I think the initial position was such that we had to move on both fronts, because on both fronts there was simply too much generosity. Now we are moving in that direction. Lithuania has already moved in that direction, and I noticed that indeed now the question is, what is the optimal real estate taxation if you don't have mortgage interest deduction anymore? And then there is the second channel, that if housing wealth is treated more favorably under the tax system than other forms of investment, you can still get overinvestment in housing, and you can still get some of that macroeconomic volatility, although less so than in my country, but still you can have it. And that's why I think the proposals that are made in this country are worthwhile considering.
Tęsiant, tai ar gali būti, kad Lietuvoje NT mokestis irgi sąlygotų mažiau kapitalo nukreipimą būtent į gyvenamąjį būstą kaip investiciją, tarkim? Galėtų?
Tame tarpe, taip. Taip.
Ir tada kitas klausimas, truputį kita tema. Čia praėjusią savaitę, man atrodo, SEB banko ekonomistas Pavilauskas išstojo ir pasakė, kad Lietuvoje komerciniai bankai atlieka ECB vaidmenį didindami maržas, nes ECB nedidina palūkanų, ar ne? Tai gal galėtumėt pakomentuoti tokį pasisakymą, kaip vertinat?
Nu, tiesą sakant, aš nustebau perskaityti šitą komentarą, nes aš tikrai nemanau, kad komerciniai bankai kažkaip veikia vietoje Europos centrinio banko ar padeda Europos centriniam bankui įgyvendinti savo pagrindinį tikslą, tai yra kainų stabilumą. Be abejo, kaip agentai, kaip tarpininkai, jie tikrai yra svarbi tos ekosistemos dalis, bet kalbėti, kad maržų didinimas tokiu būdu stabdo kainų augimą Lietuvoje, aš nesutinku su tokia argumentacija. Mano galva, čia mes kalbam kaip tik pajamų kontekste ir čia daugiau yra argumentavimas, o vis dėlto kodėlgi mažoj palūkanų aplinkoj maržos mūsų labai koncentruotoje bankinėje rinkoje didėja. Tai čia yra argumentacija, kodėl pabandyti pagrįsti maržų didėjimą, ta prasme, kitais argumentais, apart to, ką mes bandom pasakyti, kad koncentracija iš tikrųjų yra didelė. Man klausimas turbūt būtų bankai.
Gal dar galima gerbimo svečio paklausti, gal atsimenate, ar sunku buvo jūsų šalyje įvesti nekilnojamojo turto mokesčius, ar buvo susidurta su visuomenės verslo pasipriešinimu, jeigu taip, tai kaip buvo tvarkomas?
Well, the history of taxation of mortgages and housing in the Netherlands has been a very long history. It started in 1893. And initially, the mortgage interest deduction was more sizable than the wealth taxation element in it. So that made it a very popular tax to begin with, because there was, for most people, there was more deduction than there was addition to the tax base. Now, gradually over time, we are diminishing the deduction element, so the mortgage interest deduction is gradually being scaled back. It was a political taboo for a very long time. I think the Netherlands Bank already from the late 1990s, so my predecessors, warned for this tax and warned for the distortive elements, and it took the government until 2012, 2013 to finally acknowledge that this was an issue and to start taking measures. Now, 5-6 years down the road, I don't think that there is much resistance anymore. So this analysis is widely shared. Homeowners don't like it because they lose a financial advantage. So everybody understands that transition needs to be smoothed out. But there is no fundamental debate in my country anymore that we need to scale back this mortgage interest deduction. And there is also an understanding that what is then left, the taxation of the wealth in housing, needs to be roughly similar to the taxation of other wealth components in the tax system. But it took some time before it was accepted. As with most reforms, I would say.
O aš gal tada galite sukonkretinti, kaip atrodo pas jūs tie mokesčiai, kokio dydžio, kas juos moka?
At this moment, there is a sort of imputed rent tax for homeowners. So the value of the property determines what would be a hypothetical rental value if you had to rent instead of buying the house, and that is counted as an additional income element in the Netherlands, and then it is taxed against the normal tax rate against which income is taxed. Effectively, it is somewhere on the order of magnitude of 0.5 to 0.7, 0.8% of the value of the house. And that is the addition to the income, on which you then pay, according to how high your overall income is, either 36, 42 or 52%, depending on in which tax bracket you are.
Gal dar pono Vasiliausko paklausčiau pasitikslinti, ką tik sakėt kolegijai, kad nekilnojamojo turto mokesčiai platesni galbūt pamažintų investicijas nekilnojamojo turto rinką. Tai ar Lietuvos banko akimis jūs gal matytumėte šiuo metu tokį poreikį, ar viskas jūsų akimis stabilu?
Ne, žiūrėkit, tai ta prasme, vėlgi, iš finansinio stabilumo perspektyvų mes dabar nematom kažkokių didesnių problemų. Kadangi paskolų srautas, paskolų būtent namų ūkiams srautas yra maždaug apie 9%, kainų didėjimas yra maždaug tarp 6–7%, darbo užmokesčio didėjimas yra maždaug tarp 9–10%. Tai iš finansinio stabilumo perspektyvų, ta prasme, mes čia nematom kažkokių burbulų formavimas. Todėl, kalbėdami apie nekilnojamo turto mokestį, mes jo dabartinėme etape nematom kaip finansinio stabilumo priemonės, ta prasme. Nes čia daugiau yra kalba apie fiskalinę politiką ir jos tolygumą. Nes vėlgi, turto mokesčiai yra mažiau arba yra daugiau mažiau neutralūs verslo aplinkai kaip tokiai, ta prasme. Tai yra labai paprastai administruojamas mokestis, kada tu turi masinio vertinimo sistemą iš tikrųjų ir tiesiog tu sėdi ant pečiaus, maskatuoji kojom, o srautas eina.
Tai ačiū visiems už klausimus, ačiū už atsakymus. Geros dienos.
You're welcome.